Welcome to Volume 1 of the EMA Files. We're decoding the most widely used exponential moving average strategies all over the internet. No hype, no screenshots, just structure and logic. Today, we begin with one of the most talked about systems on the internet, the 9 and 21 EMA strategy. Some traders call it the pulse of the market, a simple crossover that claims to catch trends before they explode. But does it really give you the edge, or is it just another clean-looking setup that only works when the trend is obvious? Does it perform the same way in volatile markets as it does in smooth ones? What happens when price starts ranging instead of trending? So before we label it powerful, before we call it reliable, before we trust it with capital, we need
answers.
Let's break it down. To add this, go to the indicator section. Search for exponential moving average and add it to your chart twice. Set the first EMA length to 9. This will be your fast-moving line that reacts quickly to price. Then set the second EMA length to 21. This will act as your short-term trend baseline. For clarity, color the 9 EMA blue and the 21 EMA yellow so you can easily distinguish between momentum and structure. Once both are applied, your chart will clearly show the interaction between short-term momentum and short-term trend. And that interaction is the foundation of this entire strategy. The setup begins with the bullish crossover, when the 9 EMA crosses above the 21 EMA. This is not your entry yet. It's your alert that momentum may be shifting upward. After the crossover happens, wait for price to stay above both EMAs and show strength. Your entry comes on the pullback, when price retraces toward the 21 EMA and forms a bullish rejection candle, such as a strong close back above the 9 or a clear bounce from the 21. That's your confirmation to enter the trade. For your stop loss, place it below the most recent swing low form during the pullback. This protects you in case the crossover fails and momentum reverses. Your take profit can be set using a fixed risk-reward ratio, such as 1:2 or 1:3, meaning you aim to make 2 or 3 times what you risk. Alternatively, you can trail your stop and stay in the trade as long as price continues respecting the 9 EMA, exiting only when the 9 crosses back below the 21. This way, you're not blindly buying the crossover. You're entering with confirmation, protecting your downside, and defining your upside before the trade even begins. Now, for short setup, it begins with the bearish crossover, when the 9 EMA crosses below the 21 EMA. This is not your entry yet. It's your alert that downside momentum may be building. The cross tells you that recent price action is weakening faster than the short-term trend baseline. But just like the bullish setup, this is only a signal to prepare, not to jump in immediately. After the crossover, wait for price to stay below both EMAs and show clear weakness. You want to see sellers maintaining control. Your entry comes on the pullback, when price retraces upward toward the 21 EMA and forms a bearish rejection candle, such as a strong close back below the 9 EMA or a visible rejection from the 21. That's your confirmation to enter the short trade.
Order filled.
You're selling into a pullback within a developing downtrend, not chasing the breakdown. For your stop loss, place it above the most recent swing high form during the pullback. This protects you if the crossover fails and the market shifts back to bullish momentum. Your take profit can be set using a fixed risk-reward ratio like 1:2 or 1:3, ensuring your winners outweigh your losses. Alternatively, you could trail your stop above the 9 EMA and remain in the trade as long as price continues respecting it as dynamic resistance, exiting only when the 9 crosses back above the 21. The 9 and 21 EMA strategy works best on the 1-hour time frame, which is also one of the most widely used time frames among traders because it offers a strong balance between signal quality and trading opportunities. On lower time frames like 5 or 15 minutes, the EMAs tend to produce too many false crossovers due to market noise, especially during ranging conditions. On higher time frames like the 4-hour, signals are cleaner but less frequent, making it more suitable for patient swing traders. The 1-hour chart, however, provides enough volatility to capture meaningful moves while filtering out much of the intraday noise. I have backtested this strategy extensively and took multiple trades using this exact 9 and 21 EMA setup on the 1-hour time frame, and the overall win rate came out as 73%. That means out of every 100 structured trades following the crossover, pullback entry, proper stop loss below or above the swing point, and disciplined take-profit rules, 73 closed in profit. However, this number is not magic and it is not guaranteed. The win rate can improve if you trade strictly in the direction of the higher time frame trend and avoid sideways. Choppy markets where EMAs tend to produce multiple fakeouts and fishhook signals. There were losing trades, there were false crossovers, and there were moments where patience would have filtered out weak setups. And that's exactly why rules matter. The edge comes from structure, confirmation, and risk management, not from blindly buying or selling every cross. And that concludes Volume 1 of the EMA Files. If you want to see the next episode of the EMA Files, subscribe and stay tuned for Volume 2, Changes Everything.